A quick disclaimer, this video is for education purposes only. Forex involves a high risk reward and a high risk business, and you should not trade with money that you cannot afford to lose. This channel serves as an education purposes and not as an advice to buy or trade in Forex instrument. See the description below in this video for full disclaimer. Welcome to FX Newpip. This will be our fourth lesson in beginner course, and in this lesson I will cover what is lot size, leverage, and understand leverage. Let's get started. Forex is traded in specific amounts called lots, and different Forex brokerage house offers a different types of trading accounts which represent the number of currency units you will trade in Forex. Understanding lot is very important to your Forex trading because it will affect your trading strategies and your account risk. In Forex trading, there are four main types of lots. Let's start with standard lots. Standard lots is equivalent to the volume of 100,000 units. When you purchase one lot of a currency pair, you are buying 100,000 units of the base currency. For example, if you buy on Euro USD, means you are buying the base currency of 100,000 Euro. When you start to trade Forex in the near future, you will often see lot this term. So remember, when one lot means you are commanding a volume of 100,000 units. A mini lot is equivalent to 10,000 units or 0.1 lot. Micro lot is equal to 1,000 units or 0.01 lots. And lastly, nano lot is equivalent to 100 units. Mini lot, micro lot, and nano lot is suitable for beginners trader. It is highly advisable for you to start with one of these three types of account when you have understand how Forex trading works. My advice to you is to go for free account, or we call it demo account. First, before you start to open a real trading account, take demo account for practice, try your skill, and once you are confident to trade using real money, then you can open a real account. But remember, commodities like gold, crude oil, silver, etc. has another types of calculation. For example, one lot of gold is equivalent to 100 ounces of gold. One lot of crude oil is equivalent to 100 barrels. In this exercise, I will use standard lot for lot size calculation to understand how much value per pip, and I will use two different scenarios. The first one if US dollar is quoted first, and the second one if US dollar is not quoted first. Both have different formulas. Now, if US dollar is quoted first, for example, pairs like US Canadian dollar, USD JPY, the formula is to take the decimal digits, divide by value, and times 100,000. Why we time 100,000 is because standard lot the number of unit is 100,000. So assume USD JPY at an exchange rate of 107.49. The calculation will be 0.01 divided by 107.49 and times 100,000, equivalent to $9.30 per pips. Why we take 0.01 is because USD JPY comes with last two decimal digits, and that is 0.49. Let's take a look at another example. Assume USD Canadian dollar at an exchange rate of 1.3828. The calculation will be 0.0001 divided by 1.3828 and times 100,000, which equivalent to $7.23. Do you notice in this calculation we use 0.0001? It's because USD CAD pair comes with 4 digits at the back, which is 0.3828. Let's have a look at second scenario when US dollar is not quoted first. For example, pairs like GBP USD, Euro USD, Australian USD, and so on. Assume GBP USD is at an exchange rate of 1.2284. The calculation is 0.0001 divide 1.2284 and times 100,000, equivalent to $8.14, and take $8.14 times back the value of 1.2284, which will bring you a total value of $10 per pip. Let's take a look at Euro USD. Assume it is at an exchange rate of 1.0969, and we will take 0.0001 divide by 1.0969 and times 100,000, which equivalent to $9.11, and times 1.0969, which is the value that will bring us a total of $10 per pip. This is another example for pairs if the US dollar is not quoted first for different types of accounts. Standard lot is equivalent to $10 per pips. Mini lot is $1 per pips, micro lot is 10 cents per pip, and nano lot is 1 cent per pip. By now, I hope that you already understand the formula and how to calculate your lot size. However, to make your life easy, you can choose to use third-party application to calculate your lot size. Importantly, you understand the formula. Why is it important to understand lot size? Because lot size will determine your account capital and risk associated when you place a trade. There are three main reasons for you why it is important to understand lot size. First is to prevent your trading account reach its margin call. I will explain margin call in our next lesson. Second, you can't predict the market. In Forex trading, always remember we are not a fortune teller or Doctor Strange who can predict possibilities. Forex market can be highly volatile. Third, lot size is for you to control your risk. For example, how much risk you're willing to lose for a trade you place. When you first start, you may also download free lot size calculator from the App Store, or you can visit third-party website that provides lot size calculator. Basically, you can find it for free on the net. Done with lot size, now let's go to leverage. Leverage is the ratio of own fund to the size of the borrowed fund provided by your broker. It does not mean that your broker lends you that fund and you will need to pay it back. Just imagine when you deposit $100 and broker lends you another $1,000. But that $1,000 leverage, you cannot withdraw it except use it for your trading only. Many misunderstood that we need to pay back our broker that leverage. Nope, you doesn't have to, but leverage can be either an advantage or disadvantage to your trading. So please understand leverage as well. Below is the sample of leverage offered by a Forex brokerage house. As you can see, there are different types of leverage you can choose when you register a new trading account. In this slide, I will use a simple illustration on how leverage works. Let's take a real estate for example. Imagine you plan to buy a house valued at $100,000. So in order for you to buy that house, traditionally we will apply loan from the banks. Assume that the bank will lend you 90% of the house price tag, which equivalent to $90,000 loan amount. You still need to pay $10,000 as your deposit. From this illustration, your house price tag is $100,000 and your down payment is $10,000. Therefore, the leverage will be 10 to 1. The difference between housing loan leverage compared to Forex leverage is you still need to pay to the bank the $90,000 loan that you took. If let's say this property increased its value to $150,000 in 5 years time, then you make an extra $50,000. If the house value decreased from $100,000 to $80,000, you still need to pay to the bank the loan amount $90,000 that you took. This haven't includes the interest rates and other costs. Let us see how leverage is applied into Forex trading. Let's say you want to start with a trading capital of $1,000, a standard account, with a leverage of 100 to 1. Your trading account now are able to trade a size of 100,000. On the left, assume your trade goes as what you analyze and the price goes up from 1.0978 to 1.0990. You are profiting 12 pips, which is equivalent to $120. Your account balance now is $1,120, which is equivalent to 12% returns. On the other hand, if your trade goes against you and the price goes down from 1.0978 to 1.0950 or equivalent to 28 pips loss, which translates to $280 loss, your account balance now is $720. Therefore, lot size and leverage is very important before you start trading. Thank you. If my Forex education channel helps you in your Forex trading journey, please remember to click subscribe and also select the bell icon to get notified every time I post a new education video. Please share this channel to your friend if you find it useful, and let's together we impact a million lives.